What if I told you the biggest financial shock of this decade isn't going to come from stocks, or crypto, or even a war in the Middle East? What if it's going to come from a metal most people think is boring? We're told silver is just gold's poor cousin, a relic, a coin for werewolves, and your grandma's cutlery. But what if that's a lie told by some of the biggest banks? And funds on the planet, a lie that's about to blow up in their faces? And what if the trigger for this explosion isn't some hedge fund guru in Connecticut, but a decision made in a boardroom in Beijing, a decision that will literally cut off the world's supply? Music swells, then drops to a tense whisper. This is the story of the silver short squeeze of 2026. It's a story about a mountain of fake paper, a real physical shortage nobody wanted to admit, and the moment China called the bluff. By the end of this, you'll understand why the old rules of the market are dead, why your phone, your car, and your retirement account are about to be caught in the crossfire. Strap in, we're going deep. It's the paper. Ocean paper, silver versus physical silver. To get why 2026 is the breaking point, you gotta understand the shell game that's been running for decades. It all comes down to one thing: paper versus physical. See, when you or I think about buying silver, we might think of a coin, a bar, something heavy you can hold. That's physical. But the big players, the banks, the institutions, they mostly trade in paper. Futures contracts, ETFs like SLV, options, derivatives. These are promises to deliver silver or cash based on its price. For one bar of real actual silver sitting in a vault in London or New York, there might be 100, even 200 claims on it in the paper market. This isn't necessarily illegal. It's a system called fractional reserve trading, and it works, as long as nobody calls for delivery of all the metal at once. It's like a bank. If all the depositors show up on the same day demanding their cash, the bank collapses. The silver market's dirty little secret. It's been a bank run waiting to happen. It's the cheerleaders for this system. Call it liquidity. It makes trading smooth. But the critics have a different name for it. They call it, because all that paper, a huge chunk of it is tied to short positions. A short seller bets the price will go down. They borrow silver or a contract for it, sell it, hoping to buy it back later cheaper, return it, and pocket the difference. When there's way more paper silver than real stuff, short sellers feel safe. They can manipulate the price down with waves of paper sales. Knowing very few buyers will actually ask for the metal, it's been a one-way bet for years. They've been leaning on the scale hard. And the regulator, the Commodity Futures Trading Commission, CFTC, they've seen it. There have been lawsuits, fines, settlements, but it's like a parking ticket for a billionaire, the profit from keeping the price suppressed, which helps their buddies in banking and keeps industrial costs low for big corporations. It's worth the occasional slap on the wrist. So the stage is set. A towering, precarious skyscraper of paper promises. A small but growing group of investors, the silver stackers, the apes, who are quietly buying and withdrawing physical metal, draining the vaults, in an industrial world that's about to wake up to a nightmare. But here's the twist everyone in the West missed. They were so focused on their own paper game, they didn't see the player who was playing a completely different game, a long game, a physical game. They didn't see China, the silent horde, while Wall Street was building its paper empire. Beijing was building something else, an empire of consumption, production, and strategic stockpiling. Let's rewind. For the past 20 years, China has been the elephant in the room for every commodity. They're the world's factory. They make our phones, our solar panels, our electric vehicles, and all of those things. They're absolutely hungry for silver. Silver isn't just jewelry. It's the most conductive metal on Earth. It's in every circuit board, every high-efficiency solar cell, every sensor in a self-driving car. The green energy transition. It's a silver-powered transition, and China knew it. So, while their industrial demand started sucking up over 15% of global supply, then 20%, then 25%, they were also doing something sneaky. They became the world's #1 importer of physical silver. Not for speculation, for their national stockpile. Think of it like their strategic petroleum reserve, but for the mineral that runs the 21st century. Reports are fuzzy. They don't publish the numbers, but analysts estimate that by the early 2020s, China had likely vacuumed up thousands of tons of physical silver, pulling it off the global market and into secure vaults. At the same time, they were securing the mines, buying stakes in operations from Peru to Bolivia, controlling the faucet at both ends. Meanwhile, in London and New York, the paper traders laughed. The price wasn't moving much. Their shorts were safe. Look, they'd say, the market is efficient. If there was a real shortage, the price would tell us. But the price was lying, because the price was based on the paper market, and the paper market was divorced from reality. The physical metal was moving east into a black box that wouldn't open again. The cause was set. The West was short paper. China was long physical. Something had to give. Then the pressure started to ramp up, and I mean really ramp up. First, industrial demand went vertical, not just a little. We're talking hockey stick. The global push for solar. A single solar panel uses about 20 grams of silver. Multiply that by the millions of panels being installed. The AI and data center, boom. Servers, switches, all needing silver-bearing components. Electric vehicles. They use about twice the silver of a gas-powered car. Second, the investment demand from the little guy didn't go away. It got smarter. The stacker community, fueled by forums and a deep distrust of the financial system, stopped buying paper ETFs. They started buying physical and demanding delivery. They'd buy PSLV or SIVR shares and then take the metal out. They were causing small but persistent drains on the reported vault inventories. The visible, registered silver in the major exchange vaults, the stuff that's actually supposed to back the paper contracts, started a steady, unnerving decline. From 350 million ounces to 300 million to 250 million. The days of cover, how many days of trading the physical stock could cover, went from comfortable to tight. The shorts started to get a little sweaty. But their playbook was always the same. Engineer a smash. When the price tried to rise, especially on thin overnight markets in Asia, they'd flood the market with a massive wave of sell orders. The price would get capped. Momentum would die. The narrative remained. No inflation in commodities. Silver is dead money. But the physical market was screaming otherwise. The premium. The extra cost you pay over the spot price to get a real coin or bar started to skyrocket. A spot might be $25, but good luck finding an American Eagle for under $35. The disconnect was now visible to anyone actually trying to buy metal. And through all of this, what was China doing? They stopped exporting. Completely. Any silver that went in wasn't coming out. They went from being the world's largest importer to a black hole. Western analysts called it temporary, logistical, inventory management. It wasn't. It was a strategic decision. They were sealing the vault. The pressure in the system was now immense. The paper lid was still on, but the physical pot was starting to shudder in steam. All it needed was a spark. The breaking point. The Beijing Decree, early 2026, the spark came in February 2026. It wasn't a dramatic invasion. It wasn't a stock market crash. It was a dry, bureaucratic announcement from China's Ministry of Commerce and the National Development and Reform Commission. The headline: Adjustments to the Catalog of Critical Strategic Material Exports. Buried in the legalese was a single seismic line. Silver, in all its forms, or a concentrate, refined bullion, was now classified as a Tier 1 strategic, non-renewable resource. Effective immediately, a complete export ban, no phase-out, no quotas, just stop. The initial reaction in Western financial markets was confusion, then a slow-dawning horror. The paper traders' first instinct was to sell. This will kill Chinese demand. It's bearish, they screamed on squawk boxes. The price actually dipped for a few hours. It was the last gasp of the paper paradigm. Because then the physical traders, the industrial users, the guys who actually have to source real metal to make real things, they panicked. China wasn't just a buyer, they were also a supplier. They refined a huge amount of the world's silver. They were a major exporter of silver in chemical forms for industry. That tap was just shut off. Overnight, the global available supply shrank by maybe 20%. Not on paper. In reality, industrial buyers in the US, Europe, Japan, and Korea went into a frenzy. They called their brokers. They needed metal now to keep production lines running. They turned to London and New York, and they were told, "We'll sell you a futures contract." And they said, "No, we need the metal." deliver it. And the system froze. The fallout. The squeeze spring-summer 2026. What happened next was a masterclass in cause and effect, a financial chain reaction in real time. Phase 1. The delivery default. The shorts on the COMEX and LBMA, who had sold promises to deliver silver they didn't have, were now being asked to perform. They couldn't. They scrambled to buy back their short positions, which means buying contracts, pushing the price up. But to buy, you need a seller. And the physical holders, smelling blood, weren't selling. They wanted the metal. The first major bank or fund fails to deliver, then another. The regulator declares a force majeure event. The market's trust evaporates. Phase 2. The price discovery rocket. With the paper market broken, the world now had to find the real price for physical silver. It was like an auction where only 3 people have what everyone needs. The price didn't climb. It gapped. $304,050 in a week, and $75, then $100. Headlines shifted from commodity shock to systemic crisis. Phase 3. The industrial heart attack. Companies making solar panels, semiconductors, and medical equipment saw their input costs triple, then quintuple. Margins vanished. Projects were canceled. Factories idled. The green transition hit a brick wall. Auto plants making EVs slowed down. This wasn't just a metal price anymore. It was threatening global GDP. Phase 4. The monetary spillover. People started asking, if the silver market was this fraudulent, what about gold? Gold, the big brother, saw a massive flight from paper to physical. The gold price surged in sympathy, breaking its own records. The dollar wobbled. Cryptocurrencies, ironically, saw a huge surge as people fled what they saw as a completely broken commodity and currency system. It was chaos. And at the center of the storm was an empty vault where the world's supply used to be, and a closed door in Beijing. The powers that be tried everything to stop it, and they failed. The strategic release. The U.S. government talked about releasing silver from its Gorfon-Trube, that's the national defense stockpile. Turns out they had almost none. It had been sold off decades ago. It was a bluff, and the market called it. The diplomatic push. Urgent calls to Beijing. You're destabilizing the global economy. The Chinese response was polite, firm, and rooted in realpolitik. We are ensuring our own energy security, technological sovereignty, and national development.
Ow.
We suggest you develop your own resources. Checkmate. The regulatory band-aid. The CFTC and other regulators hiked margin requirements, changed trading rules, and halted trading multiple times. This just made the paper market more liquid and pushed more demand into the physical market, making the problem worse. They were fixing a burst pipe by turning off the water to the whole neighborhood. The alternative scramble. Could we use less silver? Find a substitute? In some applications, maybe. But in high-performance electronics and top-tier solar cells? No, not in any meaningful time frame. The stuff is literally elemental. You can't substitute it with an app. By late 2026, a new reality set in. 1. A bifurcated market. There was now the paper price, a largely irrelevant ghost, and the physical price, which settled at a staggering premium and was set in Shanghai, not London. 2. The end of Western price setting. The London silver fix, a relic, the COMEX, cautionary tale. The new benchmark was the Shanghai Gold Exchange's silver price. The financial power center had moved. 3. Inflation embedded. The cost of anything electronic or green had just undergone a permanent, seismic reset. The dream of cheap, abundant, renewable energy got a lot more expensive. Now, you might think, wow, that's a crazy story about 2026. But hold up. This isn't just a prediction. This is a pattern on repeat. We've seen this movie before, just with different actors. Look at nickel, 2022. The LME in London had a massive short squeeze. The price doubled in 24 hours. The exchange's response? It canceled billions of dollars in trades. They broke the market to save the shorts. Trust in the LME. Gone. Where is nickel pricing moving? To Shanghai. Look at agricultural commodities. When Russia and Ukraine breadbaskets of the world went to war, the West saw a food price shock. What did major agricultural exporters do? They instituted export bans to protect domestic supply. It's the same playbook. National interest first, global market second. The pattern is clear. The era of deep, liquid, trustworthy global markets for critical stuff is over. We're moving into an era of fragmentation, of weaponization of supply chains, of strategic hoarding. And the data is screaming it. Silver industrial demand 2,300 million ounces. 2025, 600 million ounces. That's a 100% plus rise. Identifiable above-ground silver stocks 2010, approximately 2 billion ounces. 2025, under 1 billion ounces. We've been eating the inventory. COMEX registered silver to open interest ratio 2015, 1 Oz in vault for every 25 ounces of paper promises. 2025, 1 Oz for every 85 ounces of paper promises. The system is 3x more leveraged, more fragile. The math doesn't lie. The system is a cartoon character who's run off the cliff and hasn't looked down yet. China's move in 2026 isn't the cause of the crisis. It's just the moment everyone is forced to look down. The 3 takeaways. So, if this is the trajectory, what does it mean for you? Here are the 3 non-negotiable takeaways. 1. Price is not value. Paper is not asset. The most important lesson: the digital number on your screen representing the price of silver oil, it's becoming less and less connected to the physical reality of obtaining that thing. If you can't hold it, if you don't have a claim to the specific physical item, you own a promise in a system whose credibility is failing. This applies to ETFs, to futures, to a lot of things we think of as investments. The great repricing of stuff versus financial claims on stuff is here. Now the question is, when the crisis hits my corner of the world, will I be holding paper promises, or will I have something real? This isn't about fear, it's about awareness. It's about taking sensible steps to understand the world you're actually living in. Your call to action is this. First, get educated. Don't take my word for it. Go look at the CFTC's bank participation reports for metals. Look at the inventory data on the COMEX and LBMA websites. Follow the premium on physical silver dealers. See the disconnect for yourself. Second, diversify what diversification means. It's not just stocks and bonds. Think about what you use. Think about resilience. For some, that might mean a small position in physical, hold-in-your-hand assets outside the banking system. For others, it might mean investing in companies with secure, geopolitically sensible supply chains. For everyone, it means cultivating skills in a network that doesn't depend on a fragile digital grid. And third, subscribe and hit the bell. We are going deep on these unraveling systems. How South America is becoming the next front in the resource Cold War. You don't want to miss it. Story of our time is the story of things. Who makes them? Who controls them? And who gets left with nothing but a receipt when the music stops? Let's get smarter together. Thanks for watching. See you in the next one.